Why are options so popular? Exchanges are full of different propositions. Stocks, securities, bonds, futures, all kinds of financial instruments are just waiting for you to use them. Don't know which option to choose? Why not actually choose an option? What are options? Options are derivative contracts that have a unique feature included: a choice. The buyer of the option has a right, not an obligation, to buy or to sell an underlying asset for a specified price, strike price, in a specified time, at or before an expiry date. Who wouldn't like to have such a choice when it comes to managing finances? But it doesn't come for free, so the buyer has to pay the seller a premium. Feeling a bit confused? Let's take a look at some stock market examples. Call option. Mr. A buys from Miss B a call option. What for? Well, Mr. A thinks that stocks in the company Good Inc. will rise in the next few months, but at the moment he has no money to buy himself enough stocks to get a decent profit. Meanwhile, Miss B owns a big chunk of Good Inc. stocks, but she doesn't believe that their price will go up anytime soon. She needs some money here and now, but prefers not to sell her stocks as she believes she'll get some profit from them later. By buying a call option, Mr. A guarantees himself the right to buy 1,000 of Good Inc. stocks before the expiry date, let's say 3 months from now, for the same price they have now, $10 per stock. This option costs him only $100. This sum is called a premium. If the prices actually go up, he'll get a good return. The difference between $10 and current stock price minus the premium he had already paid. If the price stays the same or goes down, Mr. A loses only that $100. But what about Miss B? She must sell him those stocks, but this will happen only if the prices go up. In that case, she would lose because she won't get any profit from her stocks except the premium she already got from Mr. A. But if Mr. A chose not to buy because the stock price stays the same or drops, Miss B would still have her stocks plus the premium money. Put option. Now it's time for Miss B to buy herself an option. She thinks that the price of Good Inc. will drop soon, but nevertheless, she has some doubts about it. So she goes to Mr. A, who still believes in Good Inc.'s bright future. Miss B pays him a premium of $100 and buys herself a right to sell him 1,000 of Good Inc. stocks for $10 per stock during the next 3 months. If the stock price goes down, she gets a profit from selling them for a higher price. If the price goes up, she can still have her now more valuable stocks. In this case, Mr. A loses in a scenario when Good Inc. stock falls, as he has an obligation to buy them. If the price rises, he'll cheer himself up with a premium. Why choose an option? As you can see, options are quite a useful instrument of managing your finances. Don't forget that stocks are not the only possible asset for option. Those could be commodities, currencies, market indexes, and even weather. Options were invented mainly for hedging and still are often used that way, especially when it comes to commodities. A buyer of the option can be compared to an insurance buyer. Both pay a relatively small sum to protect themselves from a possible loss. However, staying safe is not the only reason why a lot of people choose to trade options. They are a cost-efficient solution whenever you would like to take advantage of stocks without investing a lot of money in it right now. While you're waiting until the stock price goes your way, you can invest the rest of your funds somewhere else. And that's another advantage of options. There's no rush until the expiry date. You have your time to see how things will turn out. And last but not least, if you are a buyer, not a seller, your losses are limited strictly to the amount of the premium. Sounds reassuring, isn't it? Nevertheless, you'd be wrong to think that there is no risk in options. Sellers who have obligations to sell or buy, depending on the option type, can lose big. In this case, premium would be a cold comfort for them. To profit from options, one has to be quite good in short-term price predictions. That requires luck as well as good analytical skills. And finally, let's not forget the commissions and fees, which tend to be higher with options and would affect your final profit. Considering all those pros and cons, it may not come as a surprise that options trading boomed last year. But some experts are sure that once again, the pandemic is to blame. With millions stuck at home with limited possibilities of spending money, the stock market has seen a lot of newcomers. Once they've gotten comfortable and understood the rules, they found out that options are quite similar to sports betting. And some of them have also found that betting on New York Stock Exchange is much more likely to pay off than their favorite baseball team. Well, no matter who you are, a bettor or not, do your research and invest wisely. That's all for today's video. I hope you find it interesting and helpful. Let me know what you think about trading options in the comments below. Thanks for watching, and don't forget to subscribe so you don't miss any of our new videos.